Welcome to another session on your capital investment decision under risk and uncertainty. Today we'll be talking about the specific techniques that we employ. Till now we have been dealing with the cash flow which are in a way given to us, it was certain. So today we'll be talking about how do we evaluate a project when there is some amount of risk and uncertainty available present in the cash flow. So today's topic is about the capital budgeting under or the project evaluation under risk and uncertainty. Now, before actually we go to the techniques of risk and uncertainty, we have to be very clear of the various terms that we're going to use in this session. That is the certainty, the risk, and the uncertainty. Now, the point is this classification of certainty, risk, and uncertainty, it actually is based on the on the probability that can be associated with the outcome of an event. Accordingly, we say whether a project is, an event is certain or uncertain or risky. Now, certainty is the state of nature when the outcome, normally I'm saying, when the outcome is known with absolute certainty that it will happen for sure or it will not happen for sure. Now, meaning that if an event is known to happen with certainty, it has a probability of 1, whereas the outcome, if it is, I mean, sure not to happen, then the probability will be 0. So a probability of absolute 1 or 0 means that event is certain. So naturally, if in case of a capital budgeting, when the cash flows are known with absolute certainty, with a probability of 1 or 0, that this cash flow will not happen, come whatever may, or this cash flow will surely happen. So that is a scenario where the probability is 1 or 0, and that is called a certain cash flow. Now the point is, in real life, we really don't have cases of absolute certainty. Like if I am predicting that next year I will have a 10,000 rupee cash flow, and the probability of 1 or the probability of 0 that the cash flow will under no circumstance be 10,000 rupees, then these kind of scenarios are really rare. In fact, they don't happen in real life. So real life, there is nothing called a certainty. So then the next scenario is the risk and uncertainty. Now, risk is about a situation when the probabilities of the cash flow that we are expecting in the future, these are somewhat determinable. It may be objectively determinable, it may be subjectively determinable. Now the whole issue is the issue with the risk. Now, when we say that an event is repetitive in nature and possesses a certain frequency distribution, then we say that we can attach some kind of a probability to the occurrence of that event, and that is called a risky event. So the whole issue is that it is repetitive in nature, but I cannot say with absolute certainty that this will happen in future. So basically the inability of predicting the future outcome with perfect knowledge in the future is what risk all about. Whereas when an event is not repetitive and is of a unique character, that means we have no past experience of that particular event, then it is very difficult to even associate any kind of a probability with that kind of an event. So these kind of events are known as uncertain events. Now, the uncertainty is of course a subjective phenomenon, and we cannot draw any frequency distribution or probability distribution from these kind of events. So basically, we're talking about known with absolute probability is certain. Some kind of probability can be associated with an event because we already have past experience with this kind of events, and this kind of events keep on happening. So we can attach some kind of a probability to the occurrence or non-occurrence of the event. These are called risky. And these are the events which are not repetitive. We have no past experience. We have nothing to fall back on to attach some kind of a probability to an event. These kind of things are known as uncertain events. Now, of course, till now we have been dealing with the project appraisal techniques. We have been dealing with short-term cash flow. Now we introduce the concept of risk and uncertainty here. Obviously, we'll be dealing with risk, not with the uncertainty part here, because there are I mean the how to deal with the uncertainty and all that thing. The theory is not that very developed. We'll be basically focusing our attention on the risk part here. Now, when I'm talking about a project risk, basically the project risk is, I mean, how do we measure this particular part of the project risk? Because we're talking about a risky this thing. Now, the whole issue of this capital budgeting is to maximize the farm value. So when we're dealing with a risky project meaning that the project I mean has fluctuating cash flow possible. So then that how do we measure this kind of the project's risk, and how do we deal with this kind of a risk is today's discussion. And we'll be focusing, there are a lot many techniques available, but we will focusing on these 5 most popularly used techniques for the management and measurement of project risk. So the probability distribution, the sensitivity analysis, the scenario analysis, the Monte Carlo simulation, and the decision tree analysis. These are the 5 techniques that we'll be talking in today's class. Let us talk about the first scenario, that is the probability distribution. Now, the riskiness of an investment project is basically the variability of the cash flows. Now, for example, if I am expecting a 10,000 rupee cash flow, but I attach some kind of a statement with that the expected cash flow is 10,000 rupees, but it may vary within a range of 1,000 rupees. That means it could be either 11 in the range of 11,000 or 9,000. So if I make a statement like that, then this kind of variability component creeps into my estimates. So these are called the risky outcomes. Now, suppose now I am saying that 10,000 rupee cash flow with a variability of 1,000 rupee, that means plus minus 1,000 rupee, or a variability of plus minus 3,000 rupees. Of course, you will tend to believe that a variability of plus minus 3,000 rupees is quite a big margin. So the point is, the higher the variability of the cash flow, the higher the fluctuation of the cash flow, the riskier the project is said to be. So basically, under probability distribution, what we're trying to do is we'll first try to see how variable are the cash flows. Now, for each project that we're considering, we will have to make estimates of the future cash flows. It is in the beginning of the project appraisal also we discussed about it. This is the first step in the project appraisal process, that you have to estimate the life of the project and the cash flow over the entire life of the project. Now, instead of estimating the expected cash outflow for each year, one point of estimation, what we do is we, for example, I am right now in 2024, and I am planning to invest in a particular project, and the project has probably 10 years life. So I have to estimate from 2025 onwards for 10 years, I have to estimate the cash flows for each of the year. Now, previously, ordinarily, what we used to do in the past, for 2025, I will come up with one cash flow. So one point of estimation will be there. Now, when we're talking about this risk, I will not be coming up with only one estimate for 2025, but rather probably 3 estimates or 5 estimates or 7 estimates. That means one likely and one best case scenario, one worst case scenario, or 2 scenarios which are best case and 2 scenarios which are worst case. So likewise, I'll come up with multiple number of multiple points of estimates of cash flow for the next year. In fact, for all the years, I'll come up with multiple estimates of cash flows. Now, these are called the possible outcomes. The possible, that means in 2025, probably I'll have 3 possible outcomes. So the smartness of a finance manager lies in how correctly he's estimating these points of estimates. Now, what I'll do in this way is that we will be able to consider the range of possible cash flows for a particular future period rather than the most likely cash flow. So our the margin for error here is slightly increased because I'm not estimating one point of cash flow, but I'm estimating a range within which the cash flow will happen. So that gives me certain confidence to operate with this dealing with the risk kind of technique. Now I'll show you an example here. Now see, here we're talking about two projects. The project A, that is the proposal A, and there is a something called a proposal B. Now both of them are independent projects. And see, we're talking about the various states of economy. Now, one economy is normal. That means whatever is the economy today, it will continue to remain like that. So that is the normal. Then we talk about, in the worst case scenario, we talk about a mild recession and we talk about a deep recession. Similarly, in the best case scenario, we talk about two other scenarios, minor boom and a major boom. That means economy taking off, and the worst case scenario, the economy is receding. Now you see, there are 5 cases. Ordinarily, like I said, that will be one average case and 2 or 3 worst case and best case scenarios. So here we're sticking to these 5 points of estimates. Now, if you look at the expected cash flow for the next year from proposal A vis-a-vis the proposal B. Now, proposal A will have a normal cash flow. Both of the proposals will have the normal cash flow or the average cash flow, that is 4,000 rupees. But whereas the proposal A's range is from 3,000 to 5,000 with a expectation of 4,000 as the average, the proposal B has the range of 2,000 to 6,000 with an average of 4,000. Now, intuitively, it is clear to us. I mean, we can intuitively think that, well, proposal B might be slightly risky as compared to proposal A. Our past understanding of statistics at least tells us that A has a bigger range. I mean, A has a range of 5,000 minus 3,000, which is 2,000 range, whereas B has a bigger range, that is 6,000 minus 2,000, that's a 4,000 range. So double the range here. So the first estimate or the first impression about the risk can be taken from the range, the level of range. So range of B is quite high as compared to the range of A. Now, the point is, because the finance manager, they have been dealing with this kind of risk, it's a repetitive scenario, they can assign some kind of subjective or objective probability estimate to each of these cash flow. Now, what is this they are doing? Number one, where we are assigning the probability of the state of scenario of the economy, and then accordingly what should be the cash flow. Now, if you see, the probability estimates for a deep recession is 10%. For a mild recession, it has been set at 20%. The situation continuing as it is as of today, it is 40%. Minor boom also 20%, and the major boom, there is a scenario of 10%. So under these 5 probability estimates, now you can see the proposal A, the cash flows, and the proposal B, cash flows. Now the point is, if I plot these cash flows in a graph, I mean on the x-axis, on the y-axis I'm showing you the cash flow, and on the x-axis I'm showing you the I mean on this probability, and these are the cash flows I'm showing you. Now you see, on the x-axis I'm showing you the cash flow, and the y-axis I'm showing you the probability. Now see, the proposal A and B, the mean is the same, 4,000 rupees. Okay, whereas the B will have a bigger range as compared to the A. This is the probability distribution. Both of them have equal kind of a distribution. So it is very difficult to estimate the riskiness of the project just by looking at the probability distribution. So what we'll do is, as we know, the earlier statistics has told us that range is the first estimate of your riskiness. The best estimate of the volatility, I mean the variation of the cash flow, is the a measure of the dispersion. And the best measure of dispersion that we have is the standard deviation. Now, if you look at this particular formula, now we have this. This is known as the sigma. This is a Greek letter, which is the sigma. It is known as the sigma. Sigma t. That means at the point of time of t, the sigma or the variability of cash flow at the point of time t is equal to the cash flow expected. The cash flow of x expected at time t minus the average cash flow, and this deviation is then squared and summed. Okay, so the deviation of the observable cash flow from the average cash flow is squared and then summed and multiplied with this probability, that and then the square root taken over that should give me the variability. Now this formula has been operated here in this particular table. We'll just have a look at few of the items that have been entered here. Now you see the expected, this is the safe. Now the expected cash flow, as we know here, is 4,000. The first estimate also tells us, otherwise we can also add up these things like the 3,000, like 3,000 into 0.10 plus 3,500 into 0.20 plus 4,000 into 0.40 plus 4,500 into 0.20 plus 5,000 into 0.10. So this summation gives us the expected cash flow. Now the I estimation was telling us that the expected cash flow was 4,000. Mathematically also we have derived that the expected cash flow is 4,000. Now what I'll have to do is the deviation of each of these cash flows from this this average is what we have to do. Now that is 3,000 minus 4,000 here squared and then multiplied with the probability. Okay, so we'll operate like that and then sum up all these things to get the right hand side of this particular equation. Now the point is, so you see each my 3,000 minus the expected value 4,000 squared into the corresponding probability, that is 0.10. Similarly, the observed cash flow 3,500 minus 4,000, that is the average squared into the corresponding probability. The likewise I have done for all the cells, and then the result I have summed up. Now my summation is summed up, and then the square root of the summation, the square root comes to the 548. So this is my standard deviation for proposal A. Likewise we have also done for proposal B. This is for the proposal B. Now, if you see the proposal B also, the expected, the average value or the expected value is again coming to 4,000 rupees. Though the entries here are different, but because they are scattered in the similar way around, so here your average values of the proposal A and proposal B are same. However, when we look at the standard deviation is substantially higher here. In the previous case, it was 548. In this case, it is almost double, that is 1,095. Now, what does this tell us about the proposal A's cash flow and B's cash flow? The first estimation is that proposal B, the range was telling me that in the range of A, we just saw that the range of A was 2,000. Whereas the range of B was 4,000. So the first estimation was telling me that B must have been very risky. So the standard deviation of A here now we have found out is 548, whereas the standard deviation of B works out to 1095. So our belief is confirmed that yes, B is more risky as compared to A because it has a high degree of variability. Now, the point is that it is difficult for projects to compare. The comparison can be done if we find out another statistics of this particular thing, that is called the coefficient of variation. Now, what is a coefficient of variation? It is a measure of the relative dispersion of a distribution. Like for example, proposal A, there was a distribution around 4,000. Even proposal B, there is a distribution around the 4,000. So this coefficient of variation, it will It is a relative measure of dispersion, and if you find out the coefficient of variation of A as well as B, then we can actually compare the risk of A as well as the risk of B. Now, how do we do it? Mathematically, we define it as the ratio of the standard deviation of a distribution to the expected value of the distribution. So basically, the coefficient of variation is nothing but the standard deviation that we saw just now divided by the expected value. The expected value. Now you see, in case of A, suppose I am talking about in case of A, this would have been A and this is the A. So for A we saw it was 548 divided by average was 4000. So here the values are calculated. Now if I want to do it for B, I'll change this to B, change this to B, and then I'll change this to B. So this would be 1095 divided by 4000. So this is 0.27. Now the point I'm trying to make here is, now because the coefficient of variation for the proposal B as well as the proposal A, they are comparing, and B is substantially higher as compared to A, we will safely conclude that B is substantially more risky as compared to A. Now the point is this, you might see, it might seem to you that why should we do so much when from the range itself we have known that the B is riskier. Now this is a very simplistic case that we're dealing with because we're in a classroom setup. Now for example, if you would have known that the average value of A, cash flow of A, the average value is, let us say, 2 million, and let us say the cash flow of B, the average value would have been, let us say, 4.5 million. Okay, now the standard deviation of this is, let us say, some 10,000, and the standard deviation of this is some 30,000. Then how would you know that which is the riskier one of the project? Now the point is, to be able to do that, then you have to fall back on this coefficient of variation formula, which will exactly tell you, because the coefficient of variation, once you do it for A and B, then you can easily compare them and see which project is more risky. Now, having said it, we have measured the riskiness of a project. How do we deal with the risk part? Now, in the last class, we talked about how we can modify. We can either modify the cash flow or we can modify the discount rate. So B, because it is more risky, we will change we will use a different discount rate for A and a different discount rate for B. So that is how we deal with the risk adjusted discount rate or the coefficient equivalent cash flows. So we have so many techniques that we can fall back on now to deal with this kind of a risk. But before that, we have measured the risk with absolute correctness. And this is about your probability distribution. The next is the sensitivity analysis. Now, what we do in the sensitivity analysis is, see, the in most of the variables which determine a project's cash flow, these are based on some type of a probability distribution. That's okay. But now, point for example, that how many units you are going to sell, what should be the what is going to be the selling price. So there are so many input variables that go into calculating the NPV of a particular project. Now, what we are trying to do is sensitivity analysis. It will indicate exactly how the NPV will change if I'm tinkering with or one of these particular variable changes. Okay, so this sensitivity analysis is also sometimes known as the what if analysis. Now, for example, here I've given you a very simple problem statement. What if sales are only 20,000 units rather than 25,000 units? Then what will happen to NPV? So as I told you that the cash flow is affected by so many input variables. Now, one change to the input variable will result in a different cash flow, that will result in a different NPV. Now, the sensitivity analysis talks about the final impact on the NPV if the various kinds of input figures are changing. Now, I must tell you at this point of time is that these things are always done through the Excel sheets, or there are other financial models available where you do this kind of sensitivity analysis. I'll just tell you simplistically how it is done. Then you will have to use a minimum of Excel sheet to do a sensitivity analysis. Now what very good example here is, let us say a company is thinking of introducing a new version of widgets. Now to do this, the company will require an initial investment of 1,50,000 rupees, and this investment will be required for a level of output of 10,000 units. Now, this investment is expected to pay off 20,000 cash per year for 10 years. Now, at the end of the year, the widget company, it will be able to sell the fixed asset and the equipment at a price of rupees 1 lakh. That means you are investing 1,50,000 rupees, and after 10 years, you can scrap an amount of 1 lakh rupees from the sale of the assets. Now, the cost of capital, if it is 4%, what would you do? Would you consider it a good project? Obviously, if the NPV is positive, you'll consider it a good project. Otherwise, not. Now, we'll just look at the basic calculations of this. See, the here we have done a simple calculation, that is the initial investment of 1,50,000 rupees. The output is 10,000. The life of the project is 10 years, and the discount rate is 4%, whereas the terminal value is 1 lakh rupees. So you have the NPV calculation. So how do we do the NPV calculation? If you remember the formula, the NPV, just a minute. The NPV is equal to, if you remember, summation L1 to N period cash flow at time t 1 plus get the party minus your initial investment. Okay, so here your cash flows are going to be, these cash flows are going to be in each year, it is going to be, let us say, 10,000 rupees. This value we know, the N value we know, 10 years. Okay, and this value is 4%, so 0.04, and I0 we know 1,50,000 rupees. Now I have all the values. Then you have something called a terminal value. This terminal value will result in the last year. So you have to go for another calculation for the last year. On the 10th year, you will receive 1 lakh rupee. Okay, that is. These are positive cash flow, that will be again the negative cash flow. Now you will be receiving one. So you make that adjustment. From here you will do the that is a cash flow. So that's an installment cash flow. I mean the lump sum cash flow. So what you will do is a cash flow, that is, this is like 1 lakh rupees. 1 lakh rupees divided by 1.04. This will be discounted 10 times because it is happening in the 10th year. You do these things, then you get the NPV of 79,744. This is a hugely positive one, so the NPV is good. So we can now safely conclude that this project is a good project. We can invest in it. Now we talk about this sensitivity analysis. Now you see, and that here, what are the input, what are the figures here available? You have output, you have now the input figures here are, how did we calculate this net revenue of, let us say, oh, I'm sorry, the output, sorry, this should not be to 1,000, this should be 10, this should be 20,000, I'm sorry, this should be 20,000, okay. Now the point is, what enters into this calculation of this 20,000 rupees cash flow? See, the figures that enter into this 20,000 calculation are, that is the revenue or the cash flow, is basically two cost items. Now a fixed cost item and the variable cost item. Okay, then you have the selling price. This is the fixed cost item, this is the variable cost item, then you have the selling price. Now there are three variables here which are used to not three, actually there are four. Number one is fixed cost, number two is variable cost, number three is selling price, number four is quantity sold. Now, these four variables are determining the cash flow that is happening at the end of the year. So, we can experience a change in any of these four variables. Fixed cost might change, variable cost might change, the price of the selling price per unit might change, the quantity sold might also change. We might experience change in one item or all the items together, or maybe two or three items at any point of time. So the sensitivity analysis will take into account all the scenarios and do the calculations for you. So this is my original scenario. Now the cost of production is fixed cost. Assume the fixed cost is here taken as 10,000 rupees. Okay, fixed cost is 10,000 rupees into the variable cost per unit has been calculated as 6 rupee per unit. So 6 rupee into the quantity that you are producing. Now we are producing 10,000 units. Okay, similarly the revenue is here. So this is 6,000, 60,000. So plus 10,000, that is your cost is 70,000. How much is your revenue? Your revenue is priced into the quantity, that is 9 rupee you are selling the item. So the Q is 10,000. So your revenue is 20,000, 90,000. So your net cash flow is, let us say, 20,000 rupees. That is how we did. And as I told you, these are the four input variables that go into calculation of these 20,000 rupees. Now here I have given you two scenarios. Though there are multiple scenarios possible, I've just given you two scenarios for doing the sensitivity analysis. Now you see here, even the initial payment also, initial investment also we have changed. Okay. Now in the initial investment was earlier 1,50,000 rupees. Now we are going with 1,55,000 as the pessimistic investment, and the optimistic investment of 1,40,000. That means we are investing less to achieve more. Now, the selling price here is 8 rupee. Earlier, the original scenario was 9. Now, I'm talking about a change scenario, 8 rupee or 10 rupee. Similarly, fixed cost, which was 10,000 in the original case, now we are changing it to 12. That is more fixed cost, so pessimistic, and less fixed cost, that is 8, is optimistic scenario. The unit variable price, which was 6 in the original scenario, now we are changing it to 7 or 5. Then the output was 10,000. So the output here is, sorry, the selling price was 9. Sorry, the selling, this is, so the output was 10,000 units. Now it is 9,000 units vis-a-vis 13,000 units. The life of the project, which was earlier 10 years, now it is 8 years vis-a-vis 12 years. Now your discount rate, which you had taken 4%, now it is 5% or 3%. Then you have a scrap value, which we had taken as 100, that means 1 lakh. That is now 95,000 or 1 lakh. So see here, in I just talked about four variables. In fact, we have done changes to 1, 2, 3, 4, 5, 6, 7, 8 variables. Okay. So you change, and these are the two case scenarios. Now here you have to first estimate either of the case. You have to first estimate the NPV and the cash flow. Then you talk about the NPV, and then do the scenario sensitivity analysis. Now how do we do it? I think it should be clear to you now. You first compute the cost. Let us assume for the case of optimistic. Now we'll talk about suppose, let me do it here. So we'll talk about the total cost first. Total cost is fixed cost plus variable cost. Now the fixed cost for the optimistic scenario is 8,000 plus the variable cost, unit variable cost is rupees 5 into the number of units sold for the optimistic scenario. The output is 13. So 13,000 units. So this should give you 8,000 plus 65,000. So this should give you 73,000. This is my total cost. My total revenue is equal to, so what is my unit selling price? My unit selling price is sale price is 10. Unit selling price is 10, and how many units I'm selling? I'm selling 13,000 units. So this is 1,30,000. Okay, so 1,30,000. So now my, what is my net profit or the cash flow per year? The cash flow per year is 1,30,000 minus 73,000. So this is 47,000. This is 47,000. This is my cash flow in case of optimistic. Now that you have the cash flow, now you can plug in these things into the NPV formula like this. NPV is equal to summation T is equal to 1 to N. The regular cash flow that you are having is 47,000. 47,000 by 1. But now your discount rate is 3%. 0.03 to the power T plus again the terminal value. Your terminal value here is 1,20,000. So 1,20,000 rupees. 0.03 to the power 10 minus the initial investment, that is your 1,40,000 divided by, sorry, no divided by, this is simple because this is the present value. So 1,40,000 rupees. Now you solve this, you get the NPV of the optimistic scenario. Similarly, you can do it for the pessimistic scenario. So that is how the you can add as many scenarios to this possible, as many changes to the variables possible, and then you can go ahead with the sensitivity analysis, and you can see how sensitive is the NPV to these changes to the variables, okay, that you can do. The next case is your the scenario analysis. Now, when we are talking about this sensitivity, okay, suppose next is in case of the scenario analysis, it is slight improvement over and above this sensitivity analysis, in the sense that this kind of a risk analysis technique, it considers both the sensitivity of NPV to the in a sensitive analysis we saw that how sensitive the NPV is to the changes in the input criteria. Now the in addition to that, this scenario analysis is like it with improvement on the sensitivity analysis, in the sense that the scenario analysis, in addition to this sensitivity, it also talks about the range of the likely values of the each of the input variables. So in what range they are going to fluctuate. Now if you look at the suppose the executives of your company, they will pick a bad set of circumstances, for example pessimistic scenario that we talked about in the sensitivity case, or a good set of scenario, which is the optimistic case. Now they will estimate the NPV under the bad case as well as the good condition, and then you can compare with the base NPV of all these things. Now I can give you a very small example here. What is that example is, let us say that the FBC executives regard a company's executive, they regard a drop in the unit sales below 5,000 or a rise above 40,000 units has been extremely unlikely. Okay, so their range is, the lowest is 5,000 and the highest is 40,000. So that is what, please look at the table. That is what in the worst case scenario I put the 5,000, and the best case scenario is the 40,000, and the most likely scenario is, let us say, the sales volume of 25,000. And they say that when there is a worst case scenario, that is 5,000 sales, then the selling price per unit will be 1,700. Whereas in the case of a best case scenario, that means basically the demand has picked up in the market. If there is a pickup in the demand in the market, you will sell more units. Not only you will sell more units, you will also be able to command a higher price. So here your per unit selling price is 2700 with a base value of 2200. Now the NP, using the cell volume and price and the previous calculations of your cost and revenue, we can compute the cash flow, and in accordingly we can compute the NPV. Now here we have done these NPV calculations. So the point is, not only are we talking about the sensitivity of NPV, but we are also talking about how we deal with the ranges, different ranges. So here we picked up two things. Number one, sales volume, the best case, worst case range, and correspondingly the sale price. Now the point is, you can also include into this analysis something like a, suppose the usually the variable cost operates as a percentage of the selling price. Now here you can also include the variable cost, how the variable cost will change per in terms of percentage. You can also bring in the let us say the fixed cost. Let us say if you are operating at a very high level, maybe your fixed cost will register a jump. Okay, so you can bring in all these variables into this analysis, and then you can do a wholesome scenario for the NPV range and the NPV. So here I'm telling you that the range of fluctuation of NPV is 22,000 to 50,000. Okay, however, even in the worst case, I'm experiencing a positive NPV, which is a good thing for the project, so the project can be accepted. That is how we take decision in the scenario analysis. We'll now talk about something called a Monte Carlo simulation. This is a this has to be done with a package or a program, but I'll just tell you this: it is not possible to do it with manually. So Monte Carlo simulation, you will require a computing package. I'll just give you the basic background of this thing. Now see, the Monte Carlo simulation is a computational method that simulates means it shows you by trial and error, by showing how it can be done, which simulates the behavior of a system or a process by generating random values for its inputs and outputs. Okay, so the computers generate random numbers for various inputs, and then they can make their calculations based on these random numbers. Now for example, if you want to simulate the cash flow for a project, you have to assign probability distribution to the variables that affect your cash flow. Just now we saw there are 6 to 7 variables that can affect the cash flow. You can also talk about the taxes, you can talk about the depreciation. All of these also have a, now if you're charging depreciation in one method and you change the depreciation method to another method, then that will have a direct impact on the cash flow. Similarly, taxes will also have impact. You have 10% tax, 20% tax, 30%, you will have an impact on it. So you can build in as many inputs that will have an impact on the cash flow, and you can generate random numbers for that. So you use a software or a program to generate the thousands of random scenarios based on these distributions and calculate the cash flow for each scenario. This, as I told you, this has to be done in a package. What is the outcome is, the outcome will be a range of cash flows along with the probabilities. So like for example, one cash flow, manually we changed 4 or 5 variables and we saw how the cash flow is changing. Now one cash flow, if you consider 15 input variables, 15 factors that are impacting the cash flow, and these 15 factors, they will be the cash flow will be simulated based on the changes in those 15 input factors. So the package will do that and tell you how this cash flow is going to change based on the certain changes in the input variables. Okay, then you use this kind of the prediction of the cash flows to evaluate the project's NPV, and that is what this Monte Carlo simulation actually does. Now there are certain steps that we follow while we do this Monte Carlo simulation. Now we define the project objective and what is the scope. Then you identify the key variables and assumptions about the cash flows. You assign probability distribution to the variables and the assumptions. Then you choose a software program or a tool that you are going to use for the simulation, And of course, you immediately run the simulation to generate the random number scenarios. Then you analyze the results and calculate the key metrics such as the NPV or the IRR or whatever you want to calculate the various techniques, and then compare your project metrics with the benchmark provided by the management or the general decision criteria that you have. So as I told you, it is difficult to show you a Monte Carlo simulation in live, but I'll show you the snapshot of how this looks like. Now see, here we have only picked up only selling price, and to the selling price we have generated, using the package we have generated associate the random numbers which are associated with the selling price and along with the probability which have been generated. Now the point is, in the table below you see that you have the various panels. Now what are these panels? The first row in the table, it shows you the cumulative probability. That means what is the probability of that, and then the next I'll just tell you what is that cumulative probability. Now the NPV is shown in the next line and the IRR in the next line. See, you can include as many, you can include the payback period, you can whatever technique you want to use it here, you can use that. We'll focus on the, let us say, the NPV. Now if someone asks you what is the probability that the NPV of here the NPV, let us say we're focusing on 11,390, and these are all thousands of rupees, so 3 zeros have been omitted. So if somebody tells you that what is the probability that NPV will be more than 5 million, let us say someone asks you, once you have done your simulation, what is the probability that NPV will be more than 5 million. Now you see the top line, the cumulative probability that I was talking about, this line, this particular figure I'm talking about, this one. Okay, this is the line. Now suppose we talk about 5 million. This is what amount? This is 5 1 4 4 and 3 zeros missing. So this is basically, okay, so 51 lakh 40, so basically 5 million. So if somebody asks you that what is the probability that the NPV will be higher than 5 million, now you see this is higher than 5 million and quite a bit. So the cumulative probability is 70%. You can safely say it is 70%, more than 70%, that and which is a very high probability. So it means 70% probability is there that the NPV will be 5 million or more. Okay, so that immediately we can guess from this table. So this tells you that you see here, then you have this mean value of from this cumulative probability. We have computed the mean value and the standard deviation value of your estimates. Now, how can we use that? We can immediately calculate the coefficient of variation here. Let us say the coefficient of variation. As I told you, what is coefficient of variation? The standard deviation by the the average NPV, standard deviation of NPV by the average of NPV. Now here in our example, the standard deviation is 10124. Of course, 3 zeros are missing, and this is 11228. So that works out to 0.90. Now the point is, this particular project, let us say whatever may be the nature of the project, this particular project has a coefficient of variation generated through this the NPVs that was generated through Monte Carlo simulation. The coefficient of variation is 0.90. Now suppose this project belongs to a company called ABC. Now ABC has a track record of investing in several other projects. So you can get the history of those projects, and you can always compute the coefficient of variation of several projects, and you can go for the coefficient of variation of the average projects. Okay, so if there are 10 projects, you can compute the coefficient of variations of each of these projects and average them out. So you will have the average coefficient of variation. Suppose the average coefficient of variation of this particular company works out to somewhere in the range of 0.40. Okay, whereas this particular project, whatever may be the nature of the project, this particular project is at a 0.90. So as I told you, coefficient of variation are comparable. So it means that this particular project is, let us say the project A is very risky as compared to the other projects that ABC company has been investing in. So if the company's cost of capital is 10%, obviously you will not find out the NPV at 10%, because this project is substantially high risk. So you might have to revise the discount rate or the cost of capital from 10%, because it's substantially risky. Maybe you can revise it to 13% or 14%, and then discount using the 13-14% to compute the modified NPV. So then you can take a call on whether this NPV justifies your investment in the particular project. I guess with this we come to the end of this Monte Carlo simulation, and the last thing is the decision tree approach. Now, in a decision tree approach, what we do is see the as the name indicates, the decision tree analysis. All these decisions are shown to you in tree format, in a sequential, in a node, sub-node, branches, this kind of thing. So the name is the tree here, the decision tree. Now we talk about decision tree when we're talking about the real options. Now see, what happens is, many times I'm standing here today, okay, in 2024, I'm talking about a project. I cannot know for sure what will be how the scenario is going to change in 2 years time or 3 years time. Okay, let us say the project has a 15-year life, but in 5 years time, newer options, newer developments will come to the picture, and then I have to go for a fresh decision making at that point of time. Okay, so these are called the real options. Now, every typical project has these real options embedded, which cannot be adequately dealt in the beginning, or which cannot be adequately dealt in the traditional, the discounted cash flow techniques that we are using. Now, the NPV or the IRR are all the simple DCF techniques, but 3 years down the lane or 5 years down the lane, you could have several real options, and these cannot be dealt with by the traditional DCF technique. Now, these options are dependent on new information as time goes by, because the scenario changes, the ground realities changes, the economic scenario changes. So newer information comes in and new kind of options arise. So these options have to be again built into your project decision. So for example, what could be the changes? Whether we are going to expand, whether we are going to contract, whether we are going to cease operation or abandon. Suppose you had set up a steel plant in a particular area. Now the new environment laws come into there is a foul between your operation and the environment laws. Then what kind of in the beginning when you started planning, there was no environment law in your area. Now that the environment law has come in, so you have to change your strategic decision. So how do you do? Whether you're going to expand, whether you're going to contract, whether you're going to stop operation altogether, all these things will arise as new information comes to you. Okay, now the point is, how do we deal with this kind of a scenario? I have a question here. This is not a question, actually a case, kind of a case, and a pretty long one. Let us say that a company is thinking of expanding into a new market. So what are the various scenarios that we are considering here? That is what is mentioned in this particular case. Now you see, the plant is going to cost you 3 million to build, okay, and the marketing department has told you that the market will generate the equivalent of about 5 million per year forever if the project is successful. Okay, sorry, not 5 million, 5 lakh per year if the project is successful. That means you invest 30 lakhs, And if you are successful, the project will give you 5 lakh rupees every year. But if it is not successful, then it will give you only 50,000 rupees. Now, the probability of the project becoming successful or unsuccessful is 50% each. Now, you have a discount rate of 10%. So, whether you will invest in this kind of a project or not, is it a good project? That is the question. Now, as we are talking about real options, suppose prior to that we're talking about that, let us say I am not going to invest directly 30 lakh into a project without knowing whether it is going to be successful. When the success rate is merely 50%, I might not invest. So let us say we do a trial project. The trial project is substantially less value. That is, let us say I only invest 2 lakh rupees in a trial project. Okay, and I see that if the trial project is successful, then it will give me 80,000 rupees. If it is not successful, it will give me only 30,000 rupees. And this is only a one step. There will be no further cash flow from this. Now, again, the probability of success or not success is again 50%. So the trial will be 2 lakh rupees, 50% successful, leading to 80,000 rupees one-time cash flow, and 50,000% not successful, leading to 30,000 rupees one-time cash flow. Okay. Now, but this trial project gives me certain information about my main project, that if the trial project is successful, then the probability of the full scale project becoming successful is 90%. Okay, so that means if the trial project is successful in the first attempt, then there is a 90% chance that the full project will be successful. Meaning that if I do a trial project and it is successful, then I can probably blow up my operations and become a full scale. Okay, so this is a stepwise calculation that we are doing. Now, 90% chance that your project will be successful, leading to a 5 lakh rupees, before we talked about 5 lakh rupee cash flow. And if it is unsuccessful at that level, again, there is a 10% chance that it will not be successful. Then, in that case, you will have a cash inflow of, sorry, this is not 5 lakh in the question, it is written, it is 50,000 rupees with only a probability of 25%. So another, okay, 5 lakh rupees with a probability of 25%, and the 75% chance is that it will be 50,000 rupees. So what should be the pilot project? I mean, should we undertake the pilot project? Should we then next is go into immediate full scale production or abandon anything? So this is a complicated set of scenarios that I have given you, but once I depict them on the decision tree, it will become easier to you. Now you see, this is the node, this is the first node. In the first node, we invest 2 lakh rupees, success 50%, unsuccessful 50%. So if I am successful, the 80%, then I'll get 80,000 rupees. And if I am at this point of time, I can either decide to stop, or if I continue, then I'll go for the full scale project of 30 million, 3 million, that is 30 lakh rupees. Now that project becoming successful, in 90% chance is that I'll have a 5 lakh cash flow, and 10% chance that I have this is 5 million cash flow, I have 10% chance that I'll have a 5 lakh cash flow. Now the point is, no, this is 5 lakh and 50,000. Now the point is, again, if this is unsuccessful, I stop. There is no NPV. But even when it is unsuccessful, I still continue and invest in the trial project is unsuccessful. Still, I blow up my project and invest 30 million. So there is a 25% chance that I'll have a 5 lakh rupee cash flow, and there is a 75% chance that I'll have a minimum, a mere 50,000 rupee cash flow. So the decision tree will look like this. This is the continued decision to full-fledged. This is a continued decision to the stop decision for halting. So I think with all these figures available, continue. So this is one node, this is one node. Okay, and this is the stop node. So we can calculate the NPV at each of these nodes with the cash flows. Then we can find out the final NPV and take a call on whether to stop or whether to blow up or to abandon both these trial, as I mean pilot, as well as the full blown project. So I guess this, with this we come to the end of today's class. Thank you.